Tip number 1, that's most important. As a business owner, you need to know your numbers. So what are the numbers? Number 1, your revenue. At this point, you should know your estimated revenue or income received from customers for year 2020. Another important tip that you need to know is that business owners often miss out deductions because they don't have accurate profit and loss or accurate income statements. A lot of business owners make major errors while compiling their balance sheet. So we are going to show you some examples of potential missing deductions. So the balance sheet is really a statement to represent the financial position of a company, and oftentimes to make sure that it's accurate, you actually have to reconcile your balances to date to the actual statements. One of the common area is that business owners actually lose out a lot on business mileage or auto deductions. If you have used some accountants before, you probably have heard them advising you not to claim the home office deductions. The IRS rules and regulations encourage you to claim home office deductions if you have a space dedicated and you use it exclusively and regularly for your business. Now, if you have been making donations and in the past years you are not able to enjoy the benefits because you have not or are not qualified to file itemized deductions, this year I have good news for you. Because of the CARES Act, everybody who contributes all the way up to $300 will be able to treat it as a deduction, on page 1 of your 1040 as adjustment to income that will reduce your taxes. In the month of May, I talked to you about PPP loan deductibility and the tax implications. So if you are a business owner, tax planning is very different for you in the year of 2020 for this main reason. Many business owners back in May have received this PPP Paycheck Protection Program, and these are funds that are issued by the government to support and to pay for payroll expenses during downtime. The topic today is missing business deductions. Now, why do I say that this is a common errors or common risk to business owners? Oftentimes in a tax diagnostic, when we review a Schedule C that business owner has filed previously, or a 1065 or 1120S, we realize and the business owners realize that there are actually a lot more deductions that business owners are supposed to put in or include. Today, our topic is missing credit card expenses. And this is a common error that business owners make when they submit their tax return. I will explain more. So this is a common error that business owners make. Example, you use your business credit card to make purchases. And by right, whether you have paid your credit card or not, any transaction that gets posted by or before December 31st, you can count those as a deduction. What is the secret to maximizing your deductions? What's fully deductible, what's partially deductible, and what's not deductible. What is not deductible is entertainment. Entertainment under the current tax law is not deductible. Like if you purchase tickets and then you go watch a show with your client, those are actually not deductible. Missing out-of-pocket expenses. Why do we tell you that you have to watch out for that? Because a lot of business owners just simply miss out deductions because they forgot to claim all those legitimate out-of-pocket expenses that they incur for business.
So there's going to be times where, let's say you want to go to Office Depot or Walgreens, you want to get some office supplies, pens, papers, those things, and you forgot your business card. Well, you already made the trip, so you're going to go ahead and charge it onto your personal card. So those types of expenses, because they are actually business deductions, that is considered a business out-of-pocket expense.
And this is a question that we get from business owners all the time. Charlene, can I buy a car? My friend told me if I buy a car for $80,000, we will deduct the entire $80,000. Is that true? And today we're going to share that with you.
Regarding this, let's take this example of $80,000. So let's say one person let's say you want to buy like a Maserati, right? Well, usually with Maseratis, they're probably going to be under something called the gross vehicle weight rating. So that term is very important. Anything that's under 6,000, you actually are limited to about $18,000 the first year, and then of course the following years after that you'll get a proportion of that until you reach the 5th year, which at that time you will recognize the final portion of the $80,000.
Should you pay yourself? Now, a lot of business owners ask us during this time, should I pay myself? Should I issue myself a bonus as the holiday season approaches? If you're a sole proprietor, you'll be filing a Schedule C, and the way you pay yourself is you simply issue yourself a check, and you can call it the owner's draw. This is a topic of should you pay your kids? Now, let me share with you, as a certified tax coach, this is a very effective income shifting strategies. Remember, your kids, they don't have any earnings. So technically, when you shift, your income to them, they are paying 0 taxes. Right? So for example, if you shift, a certain amount, say $10,000, those $10,000 are actually not subject to federal income tax. So today I want to talk to you about the benefits of retirement, because by doing retirement contribution, you essentially defer your taxable income to the future. So this is a very effective way if you want to reduce your taxes for year 2020. So there are 4 types of retirement plans that you can consider. So the options are SEP IRA, Solo 401k, Simple IRA, 401k, and profit sharing. Today our topic is HSA, the Health Savings Account. So what is the Health Savings Account, and how do I utilize that to reduce my taxes? So Health Savings Account function as a savings account for you to put and save money into it, but the difference is that it's not a regular savings account, because any money that you put in, you essentially get a tax deduction. First strategy that I'll be talking to you is invest in revenue generation as assets, or invest in machines, invest in equipment. So if you whether you are a dentist, or you run a manufacturing factory, what is the best time than right now to evaluate and assess the needs, because all this equipment that you purchase, as long as it's legitimately for your business and it's for business purpose, you definitely can deduct that as equipment deduction. Now the next strategy I'm gonna talk to you about is a very effective strategy. It's called Prepay Expenses. So anything that you have to incur, whether it be rent or whether it be certain marketing expenses that you have to pay anyways, for year 2021, and you're thinking, what is the best way to actually reduce your taxes? Now the answer is stop invoicing. Stop invoicing and receiving payment for this last few days of the year. And you can do that, immediately after December 31st, such as January 1st, because anything that you do after December 31st, those income received, will be considered income in year 2021 and not current year. So specifically today, we're going to talk about research and development tax credit. So how do you know that you are involved in R&D efforts? You are involved in developing and designing new product and processes. Number 2, you're involved in enhancing an existing product or processes. Net operating losses. So how do you utilize your net operating losses to maximize your refund or to reduce your tax liability? TCJA eliminated the NOL carrybacks and permitted NOLs to be carried forward indefinitely. Bonus depreciation. How does that work, and how do you benefit from it? So if you purchase any assets, any equipment, any machines, or even vehicles, you actually get bonus depreciation. Now it's very powerful, under Tax Cuts and Jobs Act, because you're allowed to deduct 100%. Let me repeat, it's 100%. So if you purchase, an equipment for $100,000, you can literally, under the current tax law, deduct 100% IRA contribution. IRA contribution, sometimes people call it IRA contribution, is a formal retirement contribution. And how does that work? Which means if you have active income, you have W-2, or if you have a business, you are more than welcome to actually open up an IRA traditional account. Now, what is QBID? QBID is Qualified Business Income Deduction, and sometimes you will also hear people mentioning it or relating it to Section 1998 deduction. So every dollar of profit, you actually get 20% of deduction. That's why it's really powerful. Specifically for PPP, there has been a lot of changes. So if you recall, Revenue Ruling 2020-27 earlier in year 2020, what Congress wanted is really for payroll expenses to be deductible even when you receive free money through PPP funds, which is the Paycheck Protection Program, but IRS disagreed. So IRS actually came out with a ruling to say that because gross income is not included as taxable income and therefore payroll expenses funded through PPP funds are technically not deductible. Now, the Congress has overruled December 27 of last year. There's a new revenue ruling, and this revenue ruling is 2021-02. It is actually saying that all payroll expenses are now deductible. So what that means to you is that PPP funds, the free money, is not taxable. However, you can deduct payroll expenses funded through PPP money. So isn't that a double bonus? Yes, absolutely. Many scenarios when business owners have bad debt and they lose out the deduction because they don't know that these are actually legitimate deductions. So when you file your tax return, if you have a bad debt situation, you do have to remember to claim those bad debt deduction because it is a deduction that would reduce your taxable income. Understanding tax bracket. Now, when you file your taxes, it's so important that you understand what does that mean to you, what's your income bracket, and in specific income bracket, how much taxes do you have to pay. Oftentimes, we hear business owners complaining or individuals complaining, how come I pay so much taxes? When can you file your taxes? When should you file your taxes? And what is the meaning of desired tax position? So the first question is, when can you file your tax return this year? The answer is February the 12th. So the sooner you want to get your refunds, the sooner you should file your tax return and not wait, because it will be direct deposited and you will get your money sooner if you file sooner. Can you get IRS audit? What is the risk of getting an IRS audit? There are several situations that IRS would audit you. So usually there are two main criteria. One is that it's really random selection, so you're unlucky or unfortunate that you have been picked to be audited. It's random, but it's also computer screening. So with the IRS system, computer screening means, let's say you fall out of the norm. Let's say in your NAICS code or in your particular industry, everybody claims, say, the range of $8,000 to $16,000 of meals expenses, but for your particular case you have $50,000 meals with your revenue size, then obviously you are outside the norm. Then in that scenario, you may trigger, there may be an audit that is triggered in the system because you are outside the norm.